William, slightly, well, first of all, if you would like to sort of expound on what you were saying about the risk premia being charged and the uncertainty, especially in the bail-in debt space, definitely feel free. Again, we may get into that a bit more in the regulatory panel. But equally, if you have any thoughts on sort of the next stage of having identified some of the issues. What's a good sort of game plan for banks at this point to react to some of the uncertainties laid out here? You have a choice of questions.
Yes, well, I agree. I agree with you that a lot of progress has been made, that a lot of effort has been, both regulators and banks themselves have exerted themselves enormously in the last few years, and there's been a lot of progress in the kind of quality of risk management within banks, particularly the large banks. I mean, it's often presented as though, again, banks are terribly opaque and that suddenly a bank can blow up. Actually, the banks that failed in the previous crisis wasn't at all a mystery. There were a couple of banks for which the business model was, turned out to be inviable because they relied too much on market funding. But the banks that failed in the UK, for example, it was totally clear that they were weak links, that their internal risk management was not what it should have been in one way or another. And so I think that improvements through the efforts made by banks, and also I think the single supervisory mechanism, when it starts to function in an effective way, I think it's tremendously difficult to set up from scratch a supervisory institution when it's not building upon an immediate predecessor institution. And so if you talk to banks, you will gather that there are all sorts of delays in getting responses on questions and approvals. And so the whole approach is taking time to bed down. But I think it's a tremendous thing for Europe that there will be a single supervisory view for a lot of the countries, and I think the quality and of the banking risk management and the confidence one can have in banks and the banking sector across those countries will be very substantially improved by that. So I think there's, in general, there's a lot of good things going on, and so it's a question of whether we slip back or whether we move forward. And so I remain optimistic that the efforts that have been engaged in will continue and things will gradually come back to a proper state of affairs.
So a positive, at least one positive from the regulatory change. That's good, an upbeat note that we've been craving. I only have, I think, 2 minutes left, so I would like to just do a lightning round, final one for everyone on the panel. We've had, a lot of different risks on the menu, but just because, as I said before, we couldn't ignore the motorcades going around town and political risk, something Axel Weber highlighted. I'd like to know, just in a few brief words, how you see the future of the EU, specifically in the macroeconomic picture and the attractiveness to investors from the outside. I don't really think we have a choice but to go to John Cunliffe first. Brexit versus Remain, how do we see it?
I'll wait until Monday morning and talk to you. I was very surprised to get that question, but I think I'll wait.
Professor?
Well, I think that, I think I'd also like to wait for Monday. I'm not sure. But I think it's a very complicated issue, and so we see how they fight it out, or how they work it out, maybe I should say.
I'm seeing a theme of uncertainty continuing here. William, you want to take a swing at that one?
I think we do have some particular event risks, of which Brexit is one, and I mean, I think that the winding down of some aspects of central bank intervention is another where we don't quite know how markets will react. I think that, I mentioned before risk premium, and Axel was saying that Axel's comments on the reduction in asset purchases, I think, is very closely related to that basically central banks are kind of winding down a way in which they were supporting the risk appetite of markets around the world. So we don't quite know whether buy-side institutions are going to be in a position to respond by having their own contribution of risk appetite. But I'm an optimistic person, so I kind of hope that things will work out and that we will continue on a solid path.
Maybe two issues. The first one, against this benchmark of what I tried to say before, where do we stand relative to the crisis? I think banks have moved way, way further than we were before the crisis. We're in a much better place now. Might not be an ideal place. Maybe there are some things to do, seventh inning type of U.S. philosophy around baseball. But I think we've moved a long way from where we were now. And I'm quoting a number that Mark Carney usually raises. Banks now hold 7 times as much capital as they held before the crisis. And that is a very strong improvement. So I do think we shouldn't be as skeptical about sort of all the achievements that have been there, not negating the fact that there's slightly more work to do. Second one, on sort of this issue about political risk in Europe, because some of the other debates will be around a lot of the, people talk about Grexit, about Brexit. I hear people in the US talk about something that they call Mexit, which is Merkel's exit, and how the refugee situation would impact on Germany and on the political leadership. If you keep inviting political bets from global markets on weekend events where you tie up money for a short period of time and you can actually sort of bet against political events, then I think Europe will continue to get global attention by markets that basically put money on these sort of binary events. That's not a good way to run an economy. People should invest in Europe because they believe there is an opportunity for long-term gains, and they should not put money in Europe because there are political risks on which they might take short-term bets. So I think Europe has to move beyond this being perceived as a political risk. That's probably the biggest single thing that we need to change to move to a better place. And there, just to finish up, to tie it back in, the whole initiative about banking union, capital market union, making Europe a more coherent place, taking political idiosyncratic risks out of Europe and moving along in a more synchronized fashion is going to be very, very key. When you ask me where Europe will be in 5 years, I think, the whole issue about moving on together is very important, but I think it has to go back to something that in the 80s we talked about, variable geometry. The whole issue about what will happen over this weekend is more about this is no one-size-fits-all union. This is a union that will ultimately not involve around a single currency, unlike maybe some of the visions or hopes were 20 years ago. We should take stock of that and adapt in our strategy to actually have more granularity, more optionality, more sort of flexibility around the edges, and more integration in the core where it's needed. So my plea for this weekend would be that the leaders of Europe are starting to recognize that the one-size-fits-all was a great strategy. After the crisis, a more realistic strategy of optionality, contracts and modularity is probably better served to preserve the status quo and ratcheting in the current degree of integration rather than risking through too ambitious agendas to really sort of risk a fallback and a setback. And I think that's going to be very important for the future of Europe.
Excellent. Well, thanks very much for that. Plenty to keep us awake, I think, for the rest of the discussions, and not all just because of risks. Thanks to everyone on the panel. And Judith, over to you.